Good evening. Welcome to Markets Today. I'm Lata Venkatesh. With me is Surabhi Upadhyay. It wasn't a good day on the bourses at all. It wasn't good for overnight on Wall Street. It wasn't good across the Asian markets. It was terrible for China with an 8% cut. Those growth concerns definitely preyed on our markets' minds, as well, of course, relatively poor earnings that came over the weekend, and, of course, a fear that the government might start looking at participatory notes, especially from Cayman Islands, more closely. All that spooked the markets, and they ended about 1.5% lower. Hi, Surabhi.
Hi, Lata. What a start to the week. We'll go over a lot of those concerns and what experts are saying about them. But first, the headlines. Steep losses for Dalal Street on the first trading day of the week. Markets succumbed to poor global cues and concerns around earnings as well as tighter P-note norms. The Nifty falls 1.9%, ending well below the 8,400 mark. The Sensex loses 550 points. All sectors end negative. Bank, infrastructure and capital goods stocks lead the fall.
The mid-cap index falls less. It has a 1.3% cut. Havells, Century Textiles and Info Edge lose between 4 and 5% each on disappointing earnings. IOB, that's Indian Overseas Bank, ends 6.5% down as gross NPAs surge for that bank to 9.4%. Geometric, however, soars 12% on strong dollar revenue growth. As well, UMAX hits 20% upper circuit, again on good results.
Speaking of results, Tech Mahindra beats muted estimates. Profits jumped 43% thanks to higher other income. Margins come in at 12.1%, beating expectations. Dollar revenue growth, however, remains flat. And Finance Minister Arun Jaitley seeks to soothe nerves on feared tighter participatory note rules recommended by the SIT, the Special Investigation Team on black money. He says government will not take any step that may hurt the investment climate in the country. Minister of State for Finance Jayant Sinha tells us that a considered view will be taken after studying the recommendations. Well, those were some of the headlines that worried the market today. We have several experts that we have lined up on the show for you. We'll listen in to, of course, Finance Minister Arun Jaitley, Minister of State for Finance Jayant Sinha and Revenue Secretary Shaktikanta Das as they try to allay market fears created by the Special Investigation Team's recommendation on participatory notes. We'll also tell you why Rhythm Desai of Morgan Stanley thinks the markets shouldn't and won't read much into this entire P-note business. We'll also get you a perspective on markets and the road ahead from Krishna Kumar Karva of MK Global Financial Services. All right, so all that coming your way over the next 25 to 30 odd minutes. But first, the action on Dalal Street. The fall in China and the SIT report on participatory notes sent bulls running for cover on Dalal Street today. Anuj is now here with the day's highlights. Anuj, not a great start to the week.
Not a great start to the week, and it's expiry week, so it was a bit of a triple whammy for the market. Apart from the China issue, the China market was down 8%, and the whole P-note controversy that was there first thing in the morning. The fact that it was the start of the expiry week also meant that technically the market had that much weight to carry, and that's why you saw the kind of decline that you saw. In fact, the market decline was secular. No sector or stock was spared, and the market ended at low point for third consecutive day. Let's talk about some of the stocks then. In terms of heavyweights, the top 6 contributors to the market decline in terms of heavyweights were all stocks from different sectors. ICICI Bank, Larsen & Toubro, Infosys, all down between 2 to 3%. Not just that, we had stocks like HDFC, Reliance Industries, Tata Motors, all of them also down between 2 to 3.5% in trades. These were the 6 big draggers on the market, but these were not the biggest losers. Take a look at the biggest losers on the index. You had a Tata Steel, before that, just a word on the banks. Axis Bank, Yes Bank and PNB were all lower by about 3 to 4%. But in terms of biggest Nifty losers, you had stocks like Tata Steel, you had Hero MotoCorp, both of them down 5%. Hindalco was down about 4%. Not just that, some more losers, ONGC, KN, Bharti, some of the stronger stocks like Bharti Airtel also falling in trade today, down about 4%. So it was a rough day. A lot of index stocks were falling 4% or more In terms of mid-cap stocks, today was about earnings, and there were some positive reactions as well, apart from some negative reactions. For example, Jindal SAW and Geometric reacted positively to the earnings, while IOB was down about 6%. So as I said, the trend now clearly with the bears, and it will be interesting to see if that trend can change up until expiry, because expiry weeks normally are about momentum, and the momentum right now is with the bears.
Oh yes, that it is. Anuj, thanks a lot for that. I'll take off from where Anuj left off. At the Indian Overseas Bank counter, that stock fell 6.5%, but practically all the banks were in the red, barring the odd SBBJ and Andhra Bank. The worry is, for IOB, for instance, the bad loans have reached 9.4%. That's as bad as United Bank was, and everyone thought that United Bank was a basket case. So it clearly shows that the pain is way more widespread. And forget the public sector banks. Look at the kind of bad loans reported by Mahindra & Mahindra Financial, MMFSL. That reported bad loans of 8%. So clearly that's an indication that there is a lot of pain to come for the entire lending space, the bank and the non-bank space. In fact, among the bigger losers were also Axis Bank, 4.25% down, just because it reported higher slippages. And ICICI Bank, which has been already having a bad run, also fell close to 3%. So the bank Nifty was a rank underperformer with a 2.25% cut. That has a lot of private sector banks getting represented in that index. It's private sector bank heavy. If you look at the PSU bank index, that also fell 2.3%. So clearly there is more pain that may be realized as and when the PSU banks announce their numbers.
All right, so those are, of course, the domestic concerns the market has to deal with. Now let's talk about the global ones. Here's a story from China that spooked our markets today. The Shanghai Composite crashed by 8.5% at the close of trade. That's the worst one-day fall in 8 years for that index. The slump was triggered by worries over the Chinese economy. The scale of the rout suggests that investors are losing faith in recent efforts by the government to prop up the market. But Adrian Moat of JP Morgan says that despite the weak economic data points, he continues to be quite positive on the Chinese market.
We've seen generally weak economic data. Notably, we had a poor PMI print out of China on Friday. So the decline in commodity markets has accelerated. Economic data was poor. There's some concerns over inflation. The price of pork has been rising, notably in China. Market participants were worried about the IMF recommendation that China unwound its support operation. And clearly sentiment is quite fragile in the Chinese market after the correction we saw over the last month.
Well, and finally, the Indian markets had one more worry specific to itself. The Special Investigation Team on Black Money on Friday raised a red flag on participatory notes, a derivative instrument through which foreign investors invest in India, and there's 2.75 lakh crores of outstanding investments via P-notes. The government tried hard to allay the fears of the market through CNBC TV 18. Actually, from the Finance Minister to the Revenue Secretary, everyone insisted that there is no need to panic.
Keeping in mind the investment environment of the country, as also the object behind the SIT investment recommendations, and then take a final view on the matter. It is too early to say what view the government would take, but the government would certainly not take any such action in a knee-jerk reaction, particularly one which has any adverse impact on the investment environment.
This is the third report of the SIT. We get proposals and inputs from many sources. This, of course, has come from the SIT relative to making sure that the black money flows in and out of the country are curtailed, and therefore it is in this regard that the report has been submitted. Obviously, our overriding priority and objective remains ensuring an excellent investment and business environment in the country. So we will naturally take all of that into account when we formulate our policy.
So what about KYC norms? Do you think there is a need to look at the KYC norms as well?
I think the KYC norms, to the best of my knowledge right now, when you look at all of the sort of reputable firms that are issuing and working through P-notes, is actually done in a fairly clear-cut and I think a fairly rigorous manner. There will of course be some gaps here and there. There will be some areas where it's not being followed as well as it should, but we should close those gaps. But I think in terms of overall policy, I think it's generally being followed in a fairly rigorous manner.
The report of the Special Investigation Team, it contains certain recommendations, and these recommendations will be examined by the government. There will be due stakeholder consultation, and after that government will take a decision. So there is no reason at this point of time to prejudge which way the government is going to decide. There is no reason for market to react adversely. There is no reason for market to sort of get a sense of panic or anything of that sort.
All right. Market experts also told us that it's premature to react to the Special Investigation Team's recommendations on participatory notes.
I think it's premature for us to react to this, frankly, because it's amongst the many things that the SIT has pointed out in its attempt to stop black money flow. So I think it's too early. I think the government has since then issued a clarification that nobody should jump to any conclusions, that any action will be taken after careful thought. Just the mention of P-notes as a potential source for black money, I don't think is going to worry too many people, especially because I think a lot of them actually have credible flows that are coming through. So I don't think they need to worry.
As far as the P-note issue is concerned, various regulations, whenever they are introduced, I'm sure the Government of India is cognizant of its impact on the capital market, and I think there will be sufficient time, etc., which will be spent before any regulations are introduced. So I don't think so that there is any knee-jerk reaction as far as the P-note issue is concerned.
All right, so now despite the panic selling witnessed in the market today, Krishna Kumar Karwa also believes that there aren't too many major challenges for the market in the long term.
As far as the markets are concerned, I think we are in this consolidation kind of a phase where we did have a decent run-up pre-results, and as the results have started flowing in, and naturally valuations being fair valuations, so obviously there is some money being taken off the table, and that's what we are possibly seeing now. From a longer term perspective, I don't think so there are any challenges. Maybe in the immediate run you could possibly see some stock price corrections happening because stocks possibly have run ahead of fundamentals.
All right, that's Krishna Kumar Karwa's view. Let's shift focus to the big results of the day. Tech Mahindra declared its quarterly numbers. The top line seemed a little better than expected, the bottom line much more so. Reema Tendulkar is here with all the finer details. Reema, tell us, good numbers?
Yes, prima facie, Tech Mahindra's numbers look slightly better than what the street was anticipating on the dollar revenue and margins. So on the top line, the company's delivered a 0.5% growth. This is better than what the company had guided. Remember, they had given a pre-quarter business update where they'd indicated that revenues as well as margins will see a sequential decline. But compared to that, they managed to deliver a 0.5% growth, so beating expectations there. Margins have declined by just about 25 basis points to 12.11%. Remember, we did expect margins to decline, but our expectation was for a 100 basis points decline in margins because of visa costs as well as Comviva seasonality. Profits, however, have seen a big jump of 43% on a quarter-on-quarter basis, and that is aided by a big swing in the other income, which has come in at 136 crore versus a loss of 65 crore on a quarter-on-quarter basis. So net-net, it's a decent quarter by Tech Mahindra. However, what you need to remember is that despite these numbers doing well, the stock has actually done fairly well from its 52-week low of 458, which it hit in the early part of July. So from those levels, we've already seen a rally of close to about 13%. And also on the top line growth, although it's maybe marginally better than the company's guidance and consensus expectations, it's still significantly less than what peers are reporting, like Infosys, TCS, as well as Wipro.
All right, Reema, thanks so much for that. Well, from one earnings to another, Ambuja Cement also reported second quarter numbers today. Nigel D'Souza now here with the analysis. How do they look, Nigel?
Well, on the top line, Ambuja Cements really met street expectations, while on the margin front, it was a bit of a disappointment. To take you through the numbers, on the top line itself, it is expected to be a subdued quarter, so it came in lower by close to around 8%. The volumes, though, came in higher by close to around 1.5%. That came in at the higher end of what the street was estimating at around 5.88 million tons approximately, though it came at the cost of realizations, because realizations took a knock of close to around 9.5%. Came in closer towards at 4,240 rupees per ton. The margins as well, they got hit. They were expected to come in roughly at around 16%. They came in at around 15.3%. So that really was a big disappointment. And the reason that the margins really got hit was that realizations were low and freight and forwarding costs as well jumped up by close to around 5%. So there was some benefit seen in power and fuel costs dipping by close to around 6%. That's because Ambuja Cements imports some part of their coal requirement and international coal prices were lower. Their EBITDA per ton, though, came in low by close to around 37% on a year-on-year basis, and on a sequential basis came in low by close to around 29% at around 620 rupees per ton. So that really will be the big disappointment that the street will have to contend with. The profitability took a hit because of a weak operational performance. We saw that the other income as well was lower, while finance costs were mildly higher. So what worked in their favor, but effective tax rate was a tad bit lower on a year-on-year basis.
Thanks a lot for that, Nigel. We'll take a break on that note. But coming up, Sudarshan Sukhani will be joining in with a technical perspective on the markets. We'll also tell you about ICICI Bank's plans to tackle its bad loans.